Good morning, everyone, and welcome to Remax Hallmark 2021 annual virtual AGM. Every year around this time of the year, we celebrated our AGM at the different regions, Toronto, Ottawa, and Simcoe County. And every year, I stood up on the stage and talked to you about the economy. But this year, I'm quite excited. I'm excited because I have a great economist, Benjamin Tal, the Chief Deputy Economist of the CIBC Bank, who is joining us this morning, and he's going to share his insight about the 2021 and real estate. Benjamin has over 2 decades of the experience in the industry, and recently he was described by IMF International Monetary Fund as the most leading expert in the real estate industry. Good morning, Benjamin. Welcome to our show.
Good morning. It's a pleasure.
How are you doing this morning?
Wonderful, wonderful. It's a beautiful day.
Fantastic. So, Benjamin, let's just start going back to March of the last year. So it was a bit of the surprise for everyone. And I'm sure for someone with your level of experience, it was quite a shock and a surprise in terms of the economy. If you can describe your thoughts in 3 words, when in the March of the last year, the provincial government and federal government went to the state of the lockdown, what was going in your mind in terms of what's going to happen to our economy?
Yes, it was an unbelievable period because we have never seen anything like that. The economy basically froze. There is nothing in Economics 101 in textbooks that tell you that a model will work in this kind of environment because it's frozen. Nothing is happening. Nothing is moving. We have never seen anything like that. It was almost impossible to predict what will be and what the next day will be like. So that was a very interesting experience. And I think that what we have learned from the 2008 recession is that when you have a shock, policymakers have to move very, very quickly. One of the issues in the 2008 recession was that policymakers, governments, central banks were moving baby steps, a little bit. This time, learning from past experience, they moved big time. One day, they cut interest rates, they started moving. When I saw that, I was more optimistic. I knew that the market will react to low interest rates, to fiscal stimulus. My number one fear was that people will get desperate with no employment. That's why this injection of money into the system, government money, was essential. I was part of the discussion with the government suggesting, do it now, do it big, don't wait. We don't have time. We'll deal with it later. And I think that worked because we have seen a situation in which we stabilized. And then we have a situation in the housing market, for example, after 2 months of nothing, all of a sudden, everybody was out of the gate. As you know, in May, June, you know the story better than anybody else. Why? Because of the power of low interest rates and the pent-up demand and the fact that government money was there to stabilize the situation. So it was a very surreal experience. We have never seen anything like that, but it tells you how important it is to move quickly in a very decisive way.
Great points. So last 4 years has been quite difficult for the Canadian, particularly for the federal government and Canadian politicians dealing with the US presidency, particularly with Mr. Trump, unorthodox way of handling the international and monetary funds. Tomorrow is inauguration day in US. What are your thoughts in terms of a new elect president, Joe Biden, and impact of his vision and his policy on a Canadian economy, and particularly the relationship of I would call it a triangle between US and Canada and China?
Yes, so first of all, yes, Trump is gone, but his supporters are not gone. We have to realize that what's happening in the US is a big story. And we cannot ignore the 75 million people that voted for Trump. It's a very divided country, which will make Biden's work very, very difficult. It's a very divided country, as we all know. And Trump was a voice for many people that were victim to globalization, victim to automation. And he was their voice. And their voice is still there. They are still unemployed or underemployed. That will not disappear. So the fact that Trump is leaving doesn't make much of a difference in terms of this reality of the American economy. And that's the number one challenge facing Biden. So that's one thing. The other, in terms of dealing with Canada, clearly, just yesterday they announced that Keystone is dead. He's going to do it tomorrow. And that's clearly something that Alberta is not happy about. But at the same time, we have to remember that it's going to introduce a lot of regulations on US energy that might ironically help Canadian energy to regain some market share. So it's not all negative. Overall, I expect much better relationship with Biden. He's going to introduce a significant amount of money into the system, $2 trillion injection in the first quarter. That will help the US economy and will prevent the Canadian economy from going down even deeper in the first quarter. They're going to spend a lot of infrastructure. We must find a way to get ourselves into the infrastructure umbrella, because at this point he's talking about just buy US, buy America. We have to convince them the way we convinced Obama back then, that buy North America is much better, so we can get ourselves into the supply chain space. So I suggest that overall it will be much easier for Canada to deal with Biden, but Biden will not be able to do everything he wants, because he still deals with a Congress that is very split, and clearly the Senate is going to be problematic, because at some issues you need 60 votes as opposed to 50 votes, and that will be difficult to get.
Great. So let's move now to our domestic issues. So in early March of the last year, like our unemployment skyrocketed. We had almost about 16% rate of unemployment, 3 million Canadian unemployed. As we move forward towards the 2020, the rate dropped drastically. Many of the jobs, they basically retracted, and we are now still sitting at about 8.5% and 9%. Majority of our unemployed sector are hospitality and the tourism business. And what is your thoughts on, in terms of the impacting of some of these jobs or some of these businesses, that they're going to completely disappear? And we are facing the affordability issue in Canada in terms of the housing, power of the purchasing. And now we are adding another equation of the unemployed sector that may shift this affordability to a severe pattern. What are your thoughts on that?
Yes, it is absolutely true, and that's a very keen observation, that this has been a very, very abnormal recession, asymmetrical recession. All the damage, 100% of job loss during this crisis were among low-wage workers. In fact, the number of jobs among high-income Canadians went up by 300,000. So it's a very asymmetrical story here that reflects the nature of the crisis, and absolutely right. It's hospitality, it's restaurants, it's the service sector. It's a service-oriented recession. So that's the bad news, and that's why government money was so important, because the unemployment rate there was extremely, extremely high, and you needed to support them. Also, this is a small business crisis. Many small businesses simply cannot continue to operate in this environment, and that's why we were pushing very hard for a reasonable rental solution for small businesses, in addition to wage subsidies, in order to make sure that the fixed cost is being taken care of. That was a failure, in my opinion, when it comes to dealing with small businesses, but that's another story. Now, the answer to your question is the following. To what extent COVID-19 is an event or a condition? If it is a condition, it will stay with us for the next 5 years, then it's an issue. But if it is an event, then I think that next year, when we have this conversation, the unemployment rate will be much, much lower than it is now. Why? Because the service sector is relatively easy to reignite. You see, in a normal recession, most of the decline is in the goods producing segment of the economy. This is not the case now. All the decline is in services. It is much easier to restart or start a new restaurant than to restart a new manufacturing facility. So the speed of the recovery will be much faster than any other recession. That's very, very important. So yes, many businesses, many restaurants will not survive, but others will start. And therefore, I believe that a year and a half from now, we will be back to where we were in 2019 or the early 2020 because of the speed. This has been very, very deep recession, but very narrow. And I think that's very, very important to understand. So there is another factor here that will help very, very quickly, is that we are sitting on a mountain of cash. What I mean by that is that most of the decline in consumption, in fact, 70% of the decline in consumption was among high-income Canadians. It's not that they don't want to spend, they can't. So they see their savings account, their checking account getting fatter and fatter. We sit on more than $100 billion of excess cash, sitting, looking for direction. They are dying to spend this money.
Interesting.
And the finance minister, I had a conversation with her, and she asked me, how do you suggest we convince people to spend this money? And I said, provide the vaccine and get out of the way. They don't need any motivation. They are motivated enough. Just give the vaccine and you will see the money being spent. And the money will be spent not on goods, because you can press a button and get the goods. The money will be spent on services exactly where you need the jobs. That's one of the reasons why I believe that the second half of the year will be very strong. But before that, we have to go through the winter, and we all know, nobody has any illusion. This is going to be a tough winter.
Yeah, for sure. $1 million question, for a practitioner in this industry for 25 years and someone that loved real estate investment, what was beside the interest rate, what do you think was the major fueling factor? Suddenly, as you mentioned, in June of last year, the real estate market skyrocketed, multiple offer. We are almost back to the era of the 2017. What do you see as why the Canadian society at large really has this major appetite towards the real estate and went on a shopping spree madness?
That's a very good question, and I think it makes sense if you think about it. First of all, I think that when you ask the layperson and would say, how come the housing market is so strong? They will say, of course, mortgage rates are very, very low. That's why. It is true that mortgage rates are very low, historically low. However, remember, in 2008, the market went down. Today, it didn't. In fact, today it was, you can say that this recession is the most housing market friendly recession ever in history. So why? The story about interest rates is true, but in 2008, they didn't know what B20 was. There was no stress test. Today there is. You know better than anybody else. I want a variable rate mortgage, I want a fixed rate mortgage, you have to qualify me at 479. Back then, you didn't have any qualification. So from a qualification perspective, interest rates today are actually higher than they were back then. And back then, the market went down, today it didn't. So it's not just about interest rates. It's about who is qualifying for those interest rates, namely people that can afford it. Going back to my previous point, that all the jobs, 100% of the jobs lost, were among low-wage individuals. Those are not home buyers, they are renters. That's why the rental market is down. At the same time, you have a very large segment of the population, much larger than any other recession, that was financially untouched by this crisis, financially. And interest rates are in the basement. They have their income. In fact, their income went up. They can qualify easily. And they say, you know what? We have been waiting for this opportunity for years. Those interest rates are a gift with my income still there. Usually interest rates go down when you lose your income. This way it was a win-win for those people. And that gave you the green light. So the secret behind the success of the housing market so far has been this abnormality of the recovery in the housing market, and the labor market, which is very, very important to understand. And that will be the case for the next a few months. I do believe that the housing market will soften with the recession, double-dip recession that we are experiencing now, but the fundamentals are still there. The money is there, the pent-up demand is there, and the ability is there, and interest rates will remain low for a while.
Fantastic. Great analogy. The way you put it together is brilliant. You touched earlier about the Canadian gotta retool themselves, reposition the employment and be a part of the supply chain. And considering the fundamental of the real estate is always has been a supply and demand. Do you foresee that we have become a nation that our economy is depend on immigration and real estate? Do you think is a sustainable model that we are going forward?
Well, I will not say that the economy is relying on real estate and immigration. It is relying on immigration, and immigration is one of the factors leading to a very strong real estate market, and that's sustainable. That's something that will continue. In fact, the opposite is the case. I think it will get even more aggressive. The reliance on immigration will rise because we are raising the targets. And therefore, the fundamentals of the housing market will not change. What we are seeing now is kind of, it was unmoved or it was frozen for a while. Then the gate was open and the pent-up demand was taking advantage of low interest rates and income, and we have seen the improvement. As I suggested, I suggest that some softness is coming in the next few months because of the winter, but the fundamentals will not change. And if I'm right about the very strong recovery in the second half, assuming a vaccine will be distributed, then you will see a very strong summer, even spring, in the housing market. Immigration is a very important part of it, and there is no reason to believe that the number of new immigrants will go down. Canada will have to work harder to get high quality new immigrants, because under Trump it was easier because he basically closed the doors. Biden is opening the doors, so we'll have to make ourselves more attractive to those high quality new immigrants. I think we can do it.
Fantastic. So let's talk about a little bit of basically, we were listed essential. Our industry was listed essential, and contrary to many critics, they thought maybe we shouldn't be essential. Was there any, from your talks with the government level or with the ministerial level, was there any reason behind it that the real estate industry was considered as an essential industry?
Well, that's a very good point. And I think that the thinking was basically, if you don't need to shut it down, don't shut it down. And you guys were extremely creative in putting together kind of a system in which you can really visit a house without being in the house. So you reduced really physical engagements, and that's something that the government was very, very encouraged by. Basically, you can let this system work without compromising safety. So you guys really were very, very creative in this space, and I think that was the secret. If you basically say, I need to have open house and 10 people have to come at the same time, the government will have said, no, you cannot do that. You simply were able to outmaneuver the government, and I think that was a good thing.
So spending, as you said, one of the best things the government, provincial and federal government did, stimulus, really encouraged basically didn't create the panic. Consumer mindset, confidence was really high. So eventually, either us or the future generation has to pay for this debt. What do you foresee as the federal and provincial government, what step they should take to balance the book maybe in years to come?
Well, what I think is happening is the following. Let's put things in perspective. We all know the numbers. The budget deficit is rising to close to $400 billion. The debt level is about 1.2. The debt to GDP ratio went up from 30 to about 50%. Now, the good thing, we started this crisis at a relatively good base when it comes to the debt level relative to other countries, so we were able to do so. Nevertheless, as you rightly said, we have to pay back at one point. At this point, the Bank of Canada is buying a lot of those bonds, so the Bank of Canada is acting as a government agency, if you wish. At one point, that will stop. That's the quantitative easing that is keeping interest rates very, very low. So who is going to pay for it? In the short term, of course, nobody, because we have a situation in which interest rates are so low, the government is simply recycling this money. The debt level went up dramatically, and interest payments on the debt actually went down. It's like taking a mortgage that is double the size and pay less interest on that mortgage because interest rates are so low. In fact, interest payments on the debt went down by $4 billion this year or last year. That's amazing, given the fact that the debt level went up to more than $1.2 trillion. So that's one thing. So short term, we can handle it. Long term, clearly it means that the society, like households, like your clients, are getting more sensitive to the risk of higher interest rates. And this means that you have to prevent this kind of shock. So one, the disease is also the cure. The increased sensitivity to higher interest rates will prevent interest rates from rising to the sky. I believe that even after interest rates start rising, and they will rise, they will not rise to the same levels that we have seen before the crisis. That's one thing. The other is that clearly with spending, government spending, before the crisis was 15%, went to 30% now, which makes sense. It will go down for sure, we know that. But it will stabilize, let's say at 17, 18% from 15%. This increase is a permanent increase because without even knowing that, we are putting together now the infrastructure, the plumbing for tomorrow's social assistance program. We're talking about a situation in which we're talking about universal daycare. That will cost money. Some elements of universal basic income, that will cost money. The modified EI system will be more expensive. That costs money, which means that government spending will see a notable increase as a share of the economy on a permanent basis. At one point, you have to pay for it. And this point will not be today, not tomorrow, not next year, not even 2 years from now. But at one point, it will start. And I think that the government will choose to raise some taxes. And they already raised taxes on big tech. They already raised taxes on options. And their desire will be to focus on capital gain. So it will be more a higher inclusion rate on capital gain. I think it will not include real estate. It will be more financial capital gain. They will go maybe after dividends. Maybe they will go take some carbon money and bring it back to general usage. And if they are totally desperate, they will go after the HST, and they might raise it 1 or 2% because that will bring you a lot of money. That's what I see maybe in 2023, 2024, as we are safely removed from the crisis.
Fantastic. So my next question is sort of twofold. So technology, COVID caused that many businesses adopt technology, Zoom, working at home. And we saw in our industry mass exodus of the consumers selling their properties within the city of Toronto and moving to the suburb or moving to other urban center. We have noticed major growth in larger urban centers such as Ottawa, Simcoe County, Durham region. Do you foresee this exodus does continue, or do you see there will be a retraction of the people coming back again to the core? And the second part of the question, your thoughts about the condo market.
So that brings me back to my basic question, which is an event versus a condition. That's the way to think about it from a long-term perspective, I believe. Every crisis, and that's very important to understand when you communicate it to your clients, every crisis is a trend accelerator. And this crisis is not very different. This trend of people moving from 416 to other areas was there before. It was just very slow. And then it was accelerated. And it was accelerated for obvious reasons. People wanted to be in detached homes, and they wanted to be away from core, and working from home allows you to do so. That makes sense, and that's reasonable, and that's a trend that started before. However, when you are in a situation, you tend to exaggerate the long-term implications of this situation, and we are in a situation. I believe that this kind of activity will continue over the winter because we will be in the situation. But when the sun starts shining, April, May, June, and we see the light getting closer and closer, and the end of this crisis, people will take a close look and say, you know what? I can get, for the same price I'm paying in Durham or Kitchener, a very nice place in 416 in the city. What I'm saying is we might reach a resistance price level outside the city that will make people think twice about this move. I also believe that the office model is not dead. Office will remain the central piece of working life. It will be a different model. There will be reduced demand for office space for sure, but you will be spending 3-4 days a week in the office. I will do the same. I suggest that maybe rush hour is almost a primitive notion, because who says that I have to be in the office at 9 o'clock and leave at 5? So it will be more flexible. My first meeting will be from home, and then I'll go to the office. It will be very flexible, but office will remain an issue and a very important part, which means that demand for space downtown will remain high, especially among young people, professionals. So to me, all this means that I see some reversal of this trend that we have seen over the past year in the coming year or two. And I will not suggest that this is a permanent change. This is basically a continuation of a trend that we have seen, but was accelerated and will go back. Therefore, I'm not really negative on 416 or 905 on the GTA as a whole. I think the opposite is the case. Immigration will come to the city, not elsewhere. That's where the jobs are. So I think that's the way to look at it, and we should not exaggerate the real estate implications of working from home. It will be there, but it will not change the model. Therefore, I see 2022 or 2023 as a continuation of 2019.
Fantastic. My last question, Benjamin, is your what do you see in the future on a horizon in 2021, possibly going even to first the half of the 2022 for real estate? And what's your advice for many of our viewers of a realtor and their clients, how to navigate the frenzy of the market that, as you and I both, we believe that will continue in 2021 and potentially for 2022?
So first of all, I think that you can count on relatively low interest rates, especially variable rates will remain low for a long period of time until maybe late 2022, early 2023, both in Canada and the US. The 5-year rate will rise a little bit, but governments and central banks will try to cap this increase. So the widening between fixed and variable will not be very dramatic, because they do need to see the housing market continuing to do well. So that's the interest rate story. So don't panic about interest rates are low now and you have to do it now. You have a little bit of time. That's one thing. The other is a situation in which I think that the winter will be weak. I will not take December as an example of how strong the market is, because on a year-over-year basis, you compare December of last year where people were traveling to December of this year, people stayed home, didn't know what to do. Okay, so I'll buy a house. So this kind of year-over-year is really misleading. We are in a double-dip recession. The economy is shrinking by 2% now, which means that the housing market will soften a little bit. It will not go down, but it will soften a little bit. You will not see this kind of sales because we are all kind of getting a bit safer at this point. So that's the winter. I think that the spring will be relatively strong, and I think that the summer will be very strong, assuming, of course, a vaccine distribution at a normal rate. So I suggest that be ready for a relatively strong spring and clearly strong summer. And if you want to do some homework, do it during the winter to get ready for this kind of environment in an environment of relatively low interest rate.
Thank you very much, Benjamin. Great seeing you as always. I'm sure our audience, they really enjoyed your insight. Ladies and gentlemen, stay tuned for the next presenter, Deborah Bain. Thank you, Benjamin.
Thank you. Bye-bye.